It's Arnie from Analyze the Trade. And today I want to sort of recap what happened to Tesla over the last week or so since the split. And I mean, if you're an investor in Tesla, you know very well what happened. The stock ran up ahead of the split, and then it tanked a day or so after the split. And let's take a look at this, and let's look at a chart. So here's Tesla's chart, and you could see, I mean, these prices are obviously split adjusted. So they announced the split probably around here when the stock was trading around 1400. So if you got in here or anywhere along this beautiful upward trending line, you were very happy. And the stock split around here at around $446, I think. And then you can see the day after the split, the stock took off, went off to the races, and it crossed 500, and then it started pulling back. So what happened here? We've got this pullback down to around 480. Then we got a much larger pullback, where at one point in that day the stock had hit close to 400. So that's pretty gut wrenching if you've got stock here, if you own stock. And then it continued to plunge until it hit around 330. Okay. And now it started coming back. And today, as I speak, it's pushing around close to 450. So what happened here? So there are a few reasons for this major pullback. The first one is simple profit taking. A lot of people that got into the stock going into the split on the belief that the stock would run up into a split were right. And a lot of those people, some people, would take profits here, as I personally did. So you had a lot of profit taking up here, and which makes sense. I mean, if you've taken this stock up, 200 points, you should be taking some profits. So that was one reason. Another reason was that Tesla announced that they were going to do, I think it was like a $5 billion stock offering in order to raise capital to build a factory in Berlin, which is a good thing. I mean, the more production facilities, the more cars they can make, the more money they can make, and that's good for the stock. However, stockholders don't like any sort of additional stock offerings because it dilutes the existing stockholders. So that was a possible reason. Then in the broader market, there was just a sort of a pullback from the high-flying stocks. Zoom announced incredible earnings. The stock popped, like 25% in a day, and that sort of marked the peak, or as they say, the blow-off top. And after that, sort of people started selling these tech high flyers and to lock in their profits. So taking all this profit taking plus a little bit of so-called bad news for Tesla precipitated this fall. Now, there was another major thing that and there was some more news which I'll get to, which happened around here. But right now we're still in this big fall, and it happened really fast. Okay, to go from 480 to 480 points in the span of a day is a lot. So what sped up this selling? So I get the profit taking and some bad news, and And being a momentum stock, just as momentum stocks move quickly going up, they move also fast coming down. And one of the things that allegedly helped accelerate this drop were options players. So let's talk about options for a second. And you're probably familiar with options, and people were buying call options on all these tech high flyers, but let's just focus on Tesla. And when someone buys a call option, an out of the money call option, so let's say Tesla's trading at 400, you buy a 450 option. Okay. So someone is selling you that option. Okay. Someone has to write that call for you. And for the most part, that's usually the market maker, the broker dealer that's making the market in this. So they've got to write all these options. So they are promising to sell you the stock at 450, but we all know that Tesla could blow through that and easily, let's say Tesla hits 480, right? So then the broker is going to be short $30 because they have to present you the stock at 450 because you have that call option. So what are they going to do? So they're not going to lose money. In order to hedge themselves, in order to prevent themselves from losing money, they buy the underlying stock. So each time they sell a call, they buy an appropriate amount of that stock. So let's take a look at a more current Tesla options pricing chart here. So these are Tesla calls ending expiring on September 18th. Okay, so and this chart was taken, I think, on September 15th, September 14th. So this chart is based on 4 days until expiration, and Tesla is trading at 410 at the time of this pricing chart. So let's say you wanted to buy a call, a 430 call. Okay, you've only got 4 days to make that work for you. And that call is going to cost you, in order to buy that call, the premium is going to be at the moment that this chart was taken, was $9.75. And you always multiply any options pricing by 100 because one options contract controls 100 shares. So it would cost you $975 to buy one contract, one call option with the expiration of September 18th and a strike price of 430. So in order for you to break even, the stock would have to hit $439. Would have to hit $439, almost 440, in order for you to break even. It has to cross that, and that you got 4 days for that to happen. And you could see the volume in this. Okay, that was just that day. You see the volume in the 420s. You see 60,000 contracts. Okay, now that would equal 60,000 contracts would equal 600,000 shares. So there are, let's say there's hundreds of thousands of shares here that some broker is going to have to buy in order to hedge their position against these calls. Okay. Now, one more thing: the delta is the relationship between a stock, the movement of a stock, and the movement of the underlying option. So, for instance, a 0.5 delta would mean that for every point the stock moves, the option will move half a point. Okay, so in order to hedge themselves, the broker would have to buy 2 shares of stock for every option they write. So you can see that the more call buying activity, the more shares that the broker's going to have to buy. So a surge of call buying activity can, in and of itself, push a stock up just by the fact that the broker has to now buy shares to hedge. Um, so just as it can push the stock up, once the stock starts moving down, and there's less of a chance that any of these call options are ever going to be exercised, right? Because if Tesla's trading at 350, then the chance that it's going to go to 440 in 4 days is very unlikely. So therefore, the broker now doesn't need that much of a hedge. So they start selling those stocks that they had bought on the way up in order to hedge the calls that they were selling. So this incredible burst of options activity, and according to reports, the SoftBank of Japan, a large Japanese investment type bank, invested around $5 billion in options contracts of stocks, including Tesla and Apple, Zoom, other high flyers. And of course, that was just part of the activity, the options activity. So you're talking about millions and millions of shares that the brokers, the market makers, had to buy in order to hedge themselves. So once the market turned and the stocks started going down, then they started to sell. They didn't need all those stocks, so they start to sell. And all that selling suddenly becomes a snowball, and it accelerated the downward move. So all those things together pushed Tesla down. Now, if you thought it was over at this point, you would have been wrong, because Tesla shareholders were hoping and expecting Tesla to be included in the S&P index, because they had pretty much achieved the requirements. They had 4 quarters of positive earnings growth, and it looked good for Tesla. And when the announcement came out that Tesla was not going to be included, the next morning, the stock took another gut-wrenching plunge, another sort of 60-point plunge, and then kept going down until, like I said, it hit around 330. So really, what's the big deal about not being included in the S&P? I mean, the advantage would be that, I guess, all the index funds and mutual funds and all funds tied to the S&P, following the S&P, would need to then purchase shares of Tesla in order to be able to mimic the S&P index. And that supposedly would have driven up some demand for Tesla stock. Now, how much of an effect that really has or not is doubtful. It doesn't have a major effect usually when stocks are included in the S&P. So the drop on this news was just totally exaggerated, and it was just part of a total market correction, really, for tech stocks, which brought down the entire market, and a lot of profit taking, combined with a little bit of not great news. I wouldn't even call it bad news, because none of the news that came out of Tesla is really bad. But not positive news, combined with the entire market correction and profit taking and the acceleration as a result of options were the factors that drove Tesla down. So what do you do, right? And obviously Tesla is moving back up. Why is that happening? Well, if you believe in the fundamentals of Tesla, then nothing changed really from here to here. I mean, the fundamentals are the same. If you believe that Tesla is fairly valued or undervalued, because it's not just a car company, even though it sells a fraction of the cars of GM, Toyota, all these other companies that its market cap is larger than them now. If you believe that Tesla is more than a car company, okay, it's a software company. It's a SaaS. It sells subscriptions. It's got all this other technology and all this other potential. Then you can make a case for a much higher valuation. Then in that case, Tesla's undervalued here. If you look at it as many of the analysts do in a more traditional sense, then Tesla is way, way overvalued because, based on the number of cars that they're going to sell, they're valued at around $1 million a car, whereas GM is selling for $10,000 per car. So if you look at Tesla as solely a car maker, then the valuations just don't make sense. And you're a fool for buying it here. However, if you view valuations in a broader sense, more as a tech company, in addition to a car maker, then you can make the case that Tesla's undervalued. So depending on what side of this you are, if you believe in the fundamentals, then you're going to be a buyer even here. Okay. Now, there's also Battery Day coming on September 22nd, where there might be some good news. But no matter what happens on Battery Day, the momentum trade seems to be back here. So, you can make a case of just hopping onto the momentum going into Battery Day and then selling at some point. Okay, you don't have to wait till it gets back up to 500 because frankly, that might not happen. Also, there's a lot of market risk right now. September is known to be a very volatile month, and there's also a very seemingly volatile election coming up, which we've already seen is riling the markets. There's a lot of unsettledness in the market, and there could very well be another correction like the one we saw last week. So, you have to decide what kind of risk you want to take, how you want to play your risk, okay? Because Tesla is the kind of stock that it doesn't move 10 points in a correction. It can move 100 points. So if you're comfortable holding on to a 100-point drop in a day, and you believe in the fundamentals, then sure, then just hold. And your valuation theory could very well play out. If you can't handle those kind of swings, then you're going to have to play more carefully. Okay, so you can day trade the stock. I mean, you could try to hop on one of these momentum rushes, and then set a target where you want to get out and sell, make a few points. You might miss some of the upside. You can always get back in, or you might catch a downdrift. Okay, and then you have to make the decision whether to cut your losses or stick it out and hope that you don't get another drop, a second leg of this correction. Now, there's a third option, and that's just to take your profit and just to sit out and wait and see what happens. Now, if you watch on the trading shows, which I love Fast Money on CNBC, and you listen to the traders, and they'll often say that they have no choice. They have to be invested in the market because of their because if they're managing other people's money, they have certain policies, certain investment policies that they have to follow based on whatever contract they have with their investors. So they have to be invested. Okay, money managers have to be invested. Hedge funds have to be invested. Mutual funds have to be invested. But individual investors, like myself and probably like you, we don't have to be fully invested in the market. I mean, like how hard it is to buy back your few hundred shares of stocks when you feel ready to do it. You can get in and out of the market easy. So if you feel nervous, if you have some profits and you just feel nervous about the instability and the volatility of the market now, then what you should do is just sell and wait it out. Now, what can happen if you do that? Well, if the market tanks again, then you're a hero for selling, and now you could take your cash and go in and buy the stocks that you love at a much cheaper price. Now, what happens if the market continues to rise, which is always possible? I mean, even if there is a correction, there could still be a rise going into that correction. Then two things: you either, well, you might have lost some potential, points going up, and listen, if you did, you did. You'll get your other chance when there is a pullback. Um, which there usually there's going to be. Okay. On the other hand, if you really feel like getting back in, so you do that. You get back in. So you missed the 30 points on Tesla, or the 10 points on Apple. You know, Big deal. If a move in Tesla, 30 points is not really that big a loss. So if you want to be in the market now, then I would tread very carefully, and be nimble, and don't be afraid to take profits, and don't be afraid to sit it out. Don't be afraid to sell and sit it out, because at the end of the day, the market is something that you can't control, and nobody knows what's going to happen. I mean, the fact of the matter is that the Wall Street people, okay, they have a much better idea of what's going to happen than you and I, and they have information that we're just never going to have. We'll have it later, but by the time we get the information, they've already traded on it. Okay, so we just have to sort of make the right decisions and follow their lead. So, know your risk tolerance, know your time frame, and just understand that you don't always have to be invested in the market. You can take a break if you feel that it's too volatile and come back later. Worst case scenario, you've missed a move, okay? And more likely you've probably saved yourself some money and a lot of stress and anxiety. So that's the story with Tesla. If you believe in the fundamentals and have a high risk tolerance, then you should be in the stock. Okay? If you're nervous, then maybe it's worth either day trading it or waiting it out. Check into analyzethetrade.com, and I'm always blogging there, and I look forward to seeing you and talking to you some more.